including somebody from Afghanistan, and I see people from New Zealand and Australia that I know, Indonesia, all over the place, Singapore, Hong Kong. All right, everybody, hi. Thanks for joining us today for this webinar called Tops and Bottoms. We'll go for a couple of hours, perhaps a little bit longer. And so be sure to ask questions as we go along. I can see your questions here on the screen here, and so do ask the questions as we come. Don't wait till the end, because it's better to ask when we're going forward, so that I can refer to charts or what have you as we're going along. Be aware that this is copyrighted material. Please do not share this on internet sites or file sharing sites or anything like that. That includes the webinar itself and also the slides for the webinar, which everybody should have gotten. Although there were a couple of people who, from Earthlink and someplace else, that the emails bounced because they wouldn't accept our IP address for some reason. So you need to send an email. If you're listening now, you need to send an email to Helen at tradingpsychologyedge.com, and she'll send you with a clean email address, and she'll send you the material. Also, for those of you in the U.S., this is just our standard disclaimer that trading is risky business, and certainly we can't take responsibility for your trading results. This is an educational seminar, and so be sure to consult a certified financial advisor before making any investment or trading decisions. Okay, let's talk about what we're going to cover tonight. Enough for it from the somebody from the Netherlands. Hi, Roy. Nice to see you. Okay, we're going to do a thorough discussion of tops and bottoms tonight, and we're going to do this from a Wyckoff perspective. Okay, I'm sure that there are other methods out there that are good, that produce good results, and that highlight tops and bottoms very nicely using indicators and that sort of thing. But we're just going to look at price action and volume, and that's it. And as I say, from a Wyckoff perspective, we're going to look at a couple of conceptual schematics, one for tops, the other for bottoms, so that you've got a picture in your mind or an image in your mind of what to look for. Okay? And as part of that conceptual schematic, we're going to look at the structural characteristics of tops and bottoms, and also the behavioral elements of them as well. These are the key items in this presentation, okay? The structural characteristics and the behavioral characteristics. We're going to look at lots of examples. You're going to know them really well by the time we're done, but pay attention to these. This is what's important, okay? This is what's important. And as we go through, I'll start with some very classic kinds of tops and bottoms where everything, all the key elements and characteristics, both behavioral and structural, can be seen. And then we'll show some that are a little more, that are, let's say, less complete. They don't have all the elements or all the structural characteristics, yet are a valid top or bottom nevertheless. And we'll take a good look at those, okay? All right. We're going to also look at, this will be fun, we're going to look at some recent tops and bottoms, the major ones, all right? The 2007 top, the 2000 top, the 2009 bottom, the 2003 bottom. There's a lot we can learn when we start to apply the structure and behavioral characteristics from our concept, from our schematic, to the major tops and bottoms. We can see this stuff, okay? We can see it very clearly, very plainly. We're also going to talk about something called upthrust after distribution. This is fairly rare. Well, I shouldn't say it's rare. It's just not that common. and I suppose rare is the opposite of not common, but it's a little bit more common than rare, but it's not particularly common. But when we see it, it's a pretty distinctive look of the market, and it has some pretty distinctive implications, and you need to be aware of it. Okay, and as we go through and we look at these, including the recent major tops and bottoms, we're also going to look at, right at the end, we're going to look at the recent intermediate bottoms in the S&Ps. We've been in this long uptrend since the bottom of the market in 2009. And we haven't really had many big pullbacks here. We had really two in all of this. One was the flash crash, which was over in a very short period of time. And the other was the downgrading of the U.S. credit market, bonds and government credit. We're going to look at the latter. We won't look at the flash crash tonight because I've done that in other webinars. But we'll look at the credit devaluation. And you're going to begin to see, as we go through all these examples, that patterns are going to emerge. And these patterns are based on market behavior. So they're not going to change. They're always going to be there. They're going to come in different flavors. They're going to have a little bit of a different look. But if you know what these patterns are based on the behavioral elements and the structural characteristics that we're going to talk about, they're going to serve you very well in the future. Okay? We're going to talk about entry ideas. I'll show you different ways to enter. We won't spend too much time on this, but I'll give you a good indications on how to do this. We're going to look pretty good at the Weiss wave, because it adds a lot of value because it measures two of Wyckoff's three laws. Does anybody know what the three laws are, by the way? What are Wyckoff's three laws of the market? And this is something you all ought to know because it's really important. All the market goes around these three basic laws. Yeah, demand versus supply. That's right, Rama and CK, good. Cause and effect, CK says, and effort versus result. That's right. And now everybody's typing in. And we've got a packed house here tonight too, by the way. I haven't done a webinar in quite some time, and it's nice to see that people still remember us, even though we haven't been too active on the blog or on the website. We'll talk about that at the very end of the evening. But yeah, effort versus result, supply versus demand, and cause versus effect. And we'll talk about those tonight. But the Weiss wave covers two of those. It certainly measures supply and demand extremely well, and it also measures effort versus result extremely well. And we won't talk about this tonight, but if you really get into the guts of the Weiss wave, it actually, in fact, does measure cause and effect as well, although not quite as useful as other ways of measuring it, like a good point and figure chart. But the Weiss wave will give us some good information on understanding tops and bottoms. We're going to also look at a topic that's really important, and that is seeing tops and bottoms on multiple time frames. And we'll look at that towards the end of the presentation. Now, if you haven't thought about this before, or if you're unfamiliar about how to think in terms of multiple time frames and see markets in terms of multiple time frames, then I guarantee you that this will open your eyes. And it certainly will be helpful to everybody in trading the tops and bottoms more effectively. And as we do that, we're going to look at bar by bar chart reading as well. Something I always like to do, and something you really have to do. Even with the Weiss wave, which kind of amalgamates the market in terms of waves, you still need to be able to read the bars. It's absolutely critical that you be able to do that. So we're going to touch on that in some detail tonight as well. And then finally, people always ask this, does this work on Forex? Does this work on cocoa? Does this work on silver? Does this work on stocks and so on and so forth? And the answer is yes. Any freely traded market on any time frame. So we're going to look at different markets tonight, and we're going to look across different time frames. Okay, so that's quite a bit to cover, and I just want to kind of press through because I know that I get kind of caught into discussions and thoughts and tangents and stuff, and I start to forget about the time, and suddenly we're going a lot longer than what we should rather. Okay, so here's a conceptual schematic on a top. Okay, and let's start going through this so that we start to get familiar with this. So the idea here is that tops and bottoms kind of repeat themselves. Again, it's not exactly the same all the time, but what we see here is, first of all, a top doesn't come in until the trend is mature. Okay, it doesn't. If we're just breaking out of a trading range, we're not looking for a top to occur. Okay, we want to see this occur in a mature trend. All right. What we're also going to see is that, not in every case, but in many cases, that the trend begins to accelerate its angle of ascent. We'll see exactly what that means, but you'll start to see that the market buyers get even more eager. This is the beginning of climactic action, where buyers, maybe they've been sitting on the sideline listening to their buddies making a lot of money on whatever market it is that they're trading, and they're kicking themselves because they haven't gotten in yet, or they could have gotten in back lower, but they didn't do it because they were afraid, or they thought this or that. And the market's just going to the moon. And so you start to see this collective action on the part of traders. And the market is just one big, massive, collective group of similar people. And not to say that everybody's going to act the same at the exact same moment. That's kind of, that doesn't really happen. But enough people act in a similar way because of their psychology, because of their trading behavior, and because of what the market is doing. And we know this. And we've known this for over a century. And so that's what we're beginning to see when the market starts to accelerate its trend. Okay. So eventually the market becomes overbought. Now, not in every case does it become wildly overbought, but many times it does. And oftentimes we will start to see that the pushes up don't have the same kind of force that they did down below. And then we start to see the shortening of the thrust. And that's pretty much almost always associated with diminishing volume. Sometimes we see some pretty heavy volume coming in and shortening of the thrust. That would be an effort to try to rally the market or push it up higher. But that effort isn't really rewarded. So that's one of the laws, right, of Wyckoff, effort versus results. So sometimes we can see that. But generally, when we see shortening of the thrust, and I'll explain this in some detail on the examples, generally we see some diminishing volume when that occurs. Right at the top, we're also going to start to see weak price bars. They're going to close off the highs. They're going to close in the middle or on the lows. And that's going to start to, as I said, even with the Weiss wave, we have to be able to read the price bars. And this is what we start to see is that the price bars themselves begin to tell us that supply is beginning to overcome the demand. And we see that with weakness in the price action. We will then see a sign of weakness. Okay, and I'll explain what that is as we go along as well. Generally, it's a big wave down on a high volume. Okay, we'll see that. And as this is all occurring in here, we're going to see what I call a swelling of the volume in the area of the top. You're going to see much more volume coming in this area because lots of eager buyers, but professional traders, for the most part, understand that it's too risky to hold stock or commodities or whatever it is that is being traded. It's too risky to hold it at that level. And so they know that, and they begin to sell into all that buying. So there's an amplification, if you will, of the volume on the part of both buyers and sellers. But that's a key thing that we're going to see, this swelling of volume in this area. And generally after the sign of weakness comes in, which is going to be a swift move down on high volume, we're going to see one of two things. It's either going to come back up and up thrust back in here, and more frequently, or just as often, I suppose, we're going to see that lower high being put in. Okay. Sometimes we don't get the big wave down. We get an up thrust in here, and then we get the lower high. There are variations on this, and we'll go through a few of them as we go along. But the basic ideas are right here in this conceptual chart. Okay? All right. Bunch of questions or comments coming in. Darren says he got a lot out of the Trade Guider webinar last week. That's good. Good to see you, Lars. Can't hear a thing. Yeah, if you can't hear a thing, the sound is good. You got to re-log in. With sign of weakness in the background, does it always need to be a lower low? No, it doesn't always need to be a lower low. Sometimes it comes back in. All right, somebody keeps saying they can't hear out there. So I'm gonna send sound is fine. Sorry for this little technical thing. I'll just send that privately to this fellow. Okay, it's 5 a.m. here and I can't hear a thing. Okay. Can you draw how volume would look in this case? We're gonna see how volume looks on individual charts. This is just going to be a schematic here. Okay, you'll see more as we go along. Okay, so that's a top. Here's a bottom. Again, we have a mature trend. We're not just breaking out from the down, from a trading range. That's indicative of the beginning of a trend, not the end of a trend. Okay, so we have to have a mature trend, and the trend begins again to accelerate its angle of descent. It becomes oversold. This is just a mirror image of the top. Things in the market are generally mirror images of one another. Tops generally take longer to form, though not always, but they typically take longer to form, especially major tops in the stock market or the S&Ps. They take longer to form than bottoms. It's harder for people to sell or sell short than it is to buy something. That's just the nature of people and the nature of traders. So there is a slight difference in that way, but there's so many different, there's so many times that the tops just come in quickly that it's almost hard to say that these days. It may have been more true in a couple of decades ago. Anyway, this is a mirror image. We become oversold. We often see shortening of the thrust, again with diminishing volume. And we start to see price bars not showing weakness, but showing strength, buyers coming into the market. We'll take a little brief look at accumulation, and I'll show you how to read that in a few examples here a little bit later. And eventually we'll put in a higher low. We might spring the market. There are different options here that you'll see, but you get the idea. I forgot to mention that after the sign of strength here at F, we will either spring the market or put in a higher low. And again, just like on a top, we're going to see that swelling of volume in the area there of the bottom. Would I say that high frequency trading is making manual trading more difficult? No, not at all. I don't really notice much of a difference. In fact, I think the volume is better with the high frequency trading. And remember what they're doing, right? The high frequency traders are trying to buy the market and then sell it right back to you a couple of ticks higher. And what they're really trying to force you to do is to buy higher, right? The market's coming in, their algorithmic programs detect a market turn, and so they start to, they're really front running. If you haven't read Flash Boys, or at least looked at some of Michael Lewis's articles on that, on high frequency trading, you owe yourself to take the time to do that. It's a very good book. It's very easy to read, and it explains high frequency trading extremely well and exactly what it's all about. So you ought to take a look at that if you're not familiar with it. But it occurs in the Globex market, it occurs in the NYMEX, it occurs in all the markets because the exchanges make money off of it. So it's not going to go away. But it's not, over the bigger picture, larger hedge funds and investment companies lose money on it because they're forced to pay up for their purchases or sell down their shorts. For the average little guy like us, I don't really think it matters all that much. Okay, so here's the top in crude oil, the recent top that occurred in late 2008 or mid 2008. You can see clearly that we're way overbought in here, right? No question about that. Well, remember we said the market also starts to accelerate, all right? I want to look at some of these elements here as we go in. Clearly we're in a mature trend. No question about that, right? And this trend has been going along and it's gotten overbought, but we're also seeing that acceleration starts to come in here, and we can kind of track that with trend channels. Okay, we were in a nice gradual sloping uptrend, very nice uptrend for quite a number of months, and then suddenly it starts to accelerate. Okay, everybody should be able to see that. Okay, and look, it accelerates even more and even more. As the top is coming into play, buyers want to get in on this. They think that oil is going to go. I think at the time there were people out of Goldman Sachs and other oracles of oil, I think they called them, said that oil was going to go to $2 a barrel. Well, if it's trading at 180 and $2 a barrel is 20 points higher, then that was that money could be made. So a lot of people were getting in on that. But that was the time when a top was most likely to come in. Okay, let's take a look at the top in gold. This was the 2011 top in gold. Now here, it's a little more difficult to see the acceleration coming in. And so we're going to shift over to a daily chart in a moment. But note here, I just marked this point on the weekly chart with A, and then we've got the top up here, right? And we're going to look at gold. Gold's a very good model for us. We're going to look at gold in some detail as we go through here. But you can see that we've got, here's A, that same point on the weekly chart. We're in that nice solid uptrend. Then it starts to accelerate and accelerate. Okay. Now notice here too, let me just catch up with my notes. I have a tendency to do this. I just kind of go along and forget about what I want to say here. Yeah, so we can, okay, here we go. Here's the note. So we can see the acceleration much more clearly on the daily chart than we could on the weekly chart. And that's often something we're going to want to do. And this is kind of the beginning of the idea of multiple time frames, okay? So we can easily see that acceleration and the climactic buying that's taking place. Look at each thrust up here is pushing, as the market pushes up, we see volume coming in here, right? And if we just kind of eyeballed this as an average volume in here, we'll do this a couple of times so you get an idea of how to do this. And we eyeballed in here an average volume. Well, you can see that this market, this volume is really starting to swell quite a bit. Right? We've got the highest volume on the chart, and it's actually this bar right here. It's not going up, it's coming down. This volume is downside volume. Okay? And then as we start to go up here, look at what volume does here. It comes down. So this is a classic climactic action where we're in a mature trend, it accelerates, we see the swelling of the volume, the climactic kind of volume, because everybody thinks that gold is going to go north of 2,000 here. And people were just flooding into this market. China was rip-roaring in its economy at the time, and people were thinking that, you know, China wants all the gold in the world and there's going to be scarcity and so on and so forth. Well, here's our sign of weakness right here. That big move down, that big wave down. We're going to look more carefully at that in a little bit, but you begin to see this, and then we get a weak rally up. This is actually an up thrust here, and that was a perfect place to go short on a daily basis. And then we get an even bigger sign of weakness coming down, and the gold market hasn't recovered really. It's not strong at all. Although we probably will still see some rally up. Okay, some more comments now. Okay, let's see. Would you say that, okay, I did that question. What is the psychology at the bottom versus top? Well, it's a good question, Bill. It's a question of greed versus fear, I suppose, right? But fear operates in both instances. We say greed, but it's really fear. I don't believe so much in greed as I do in the idea of we're fearful of missing out, fearful of not making the money, and so then we rush to judgment and get in. But you can consider it as greed if that's easier for you to think about. People want to make money. That's what trading is all about. And so they are, and they see the market going up. And as I said before, they hear their friends making money. When in 2000, when I was just starting to trade, I was working also in a medical center, and everybody was into the stock market. You know, if you went down to New York City, the cab drivers had laptops, and they were trading stocks between fares. And I remember nurses. There was a male nurse who said, "Boy, my kids are going to go through college and graduate school thanks to Microsoft." Microsoft was one of the hot stocks at the time. That was the dot-com boom. And they all got killed. They all got creamed. But they kept buying and buying. Even, you know, they would buy this here thinking what a great buy it was. And on the bottom, it's fear. The fear that the market's not going to stop going down. And that, you know, we'll look at some big bottoms that occurred, like in 2009 and 2003. And it's very scary about what's happening. And people get very panicked. And one of the ways you'll know, for example, when a bottom is coming in in the stock market, you'll see all of the you'll see the first stuff that goes usually is the cheaper stocks. And it's when the blue chip stocks, when the IBMs, when the Caterpillars, when the Boeing, when the GM, all of those stocks are being pitched over and sold. And when you see an acceleration of those kind of stocks being sold, you know a bottom is getting close because people are taking good stocks now and they're throwing them overboard. Okay. Okay. Do I draw a lot of trend channels? Yes, I do. Although I must say, trend channels are useful. They are not. They are not as good as horizontal trend lines, in my judgment, in my experience. Just notice that we were talking about greed and fear, and in this case it's greed. Just notice how the buying, notice the overbought condition in this market, brought on by the eager buyers, and they're accelerating a very mature trend. This stuff can't be sustained. You might have heard about parabolic moves. Well, these are parabolic moves here. These are parabolic moves. Wyckoff used to call them hyperbolics. Big spread. It's as if the market suddenly was injected with a hypodermic needle of adrenaline, and it shoots up where it really shouldn't be shooting up. And that's another indication here of that kind of climactic action. All right, let's take a look at some bottoms. We're going to start with a small time frame in the S&Ps here. And again, it's the same thing. We start off kind of making lower lows and lower highs here, and we start to accelerate that trend, and then it really gets going to the point where it gets oversold here. We can see a little shortening of the thrust. I'm going to explain shortening of the thrust in much better detail, but you can kind of see that, you know, we make a low here, and then a low here, and then a low here, and that thrust down, thrust, a little bit of thrust starts to shorten. And as I said earlier on, that the volume, this is a measure of volume here from the Weiss wave, excuse me, from the Weiss wave. And in my judgment, it is the only way to measure volume in the intraday markets. It can also be used on the daily and the weekly and monthly charts too, but on the intraday, this really is a really great tool. But you can see that the volume is getting less and less as the market is coming down and down and down, and it's not making as much of a thrust coming down. So this is selling, but it's not as forceful as it was, okay? And that's what shortening of the thrust to the downside indicates for us. So we get oversold, we get shortening of the thrust, and we get diminishing volume down there. And then suddenly the market gets very bullish. Hard to trade this, by the way. This is a 5-point, 8-point move in the S&Ps on this time frame. On a smaller time frame, you might be able to see it a little bit more clearly and make a trade in there. All right, let's take another look at an intraday bottom in the S&Ps. This is the market I trade most, and so I'm most familiar with this market. And it's I think the best market to trade. It's the most liquid, that's for sure. So again, we can see that here we do get accelerating move down. It's a little bit hard to draw trend lines or trend channels on it to highlight it, but you can visually see that it's way, way oversold here, and we do get some substantial acceleration down, and we get that high volume, that swelling of volume that we tend to see on the lows. And then, so we, you know, if we look at the thrust coming down, we have a thrust here, we have a thrust here, and then we have a little thrust here, and an almost tiny thrust here, right? So we have that shortening of the thrust, and the volume just diminishes right down. Okay, the volume just diminishes right down. Just to play this out a little bit more, we see a sign of strength come into the market, a bigger wave up, if you will, a bigger move up, and volume picks up. We start to see bigger volume than we've seen in a while. Market comes back. We have kind of diminished volume coming in here. We'd look to try to buy somewhere in this range or this area, and then the market pushes on up. Not a super strong push up, but it pushes up nevertheless. This was probably a bit of damage done to the market. We run from, what are we, probably around 1970 down to, well, let's just call it 1955. That's 15, 16, 17, almost 20-point run in the S&Ps. More than a 20-point run, almost a 25-point run in the S&Ps. That's quite a run in the course of a day and a half or so. So that was a lot of damage done to the market. So, we would also see this as a mature trend on this time frame. 25 points is a pretty good, very good run in the S&Ps. We don't see too many intraday runs like that. Okay, so mature trend, acceleration, can't really map it out in terms of trend lines, but we certainly get to see it. That swelling of volume, the shortening of the thrust. We start to see some, it's hard to see this because these are small, it's a little bit compressed in here, but we start to see some buying come in. We see a sign of strength, a little bit of testing, and then the market continues to push on up. Okay. This was last week. Yeah, it probably was last week. I try to make charts fairly current. We don't want to just look at old historic stuff. Okay. Now, not every top or bottom is readable. I know this is going to be hard for some of you to accept, and I know some people would just make every little effort to put in a trend line and say, oh boy, it's oversold down here. Well, that's not much of a trend line. I mean, a trend channel. It's hardly moving at all in here. And yes, there's diminishing volume, but I don't really see how to trade this, This really, to me, just looks like one swift move down. And maybe if it came into some significant support, you could make a case in here. Sometimes we see that it moves down fast in the morning and in the morning period and hits some significant support. But I don't know that in this chart. So just looking at this chart here, I wouldn't be able to make a trade off of this. And so I wouldn't know what to do here with this bottom. It's a bottom, but where do you get in? I don't know. I think you've got a bottom that apparently gets put in. We've got some strength that comes in. We can see that in terms of the bigger wave up and the volume here. So I think the first buy point would be around here at A. I don't see anything else possible really, or practical, I should say. Certainly anything is possible. You can buy that if you want to, but I wouldn't know how to do that. I don't think it really becomes clear until A. There the market's changed, again, due to the high volume, the large up volume, and then on the reaction, just very small volume. Over here, we were really coming down with strong volume. And over here, it's just light volume. So the behavior of this market has changed. And A has some strength in the price bar. You can see it dips down and closes firm. I like that. It's a nice look to a price bar. It frequently indicates, when you can combine it with some strength in the background and diminish volume to the downside, this frequently indicates the end of a down move, and it's a good spot to make a trade right in there. Okay, some comments here. How about the bottom after A? The big, that's yeah, we just talked about this. That's right. That's the spot that would make sense for me to buy. But the green big volume equals the big red volume. Right, they're about the same amount of volume, right? Nevertheless, if this market were still in a downtrending mode, you would not see this kind of volume come in. You would not see this level of buying come into the market. You'd see it die out in here somewhere, and then start making a new leg down, and this volume would probably be a lot smaller. So just because it's not bigger than it doesn't have to be bigger, it just has to show some strength. proportional. The damage shown by the red was quite a bit. Yes, it was, and it took the market some time to digest that, but notice that it's on its way here to move on up. An ABC retracement, yeah. Would this mean an inability to push? I'm not sure of what you're asking, where you're asking that question, the inability to push. Lars says regarding the strength with high volume before A. High volume before A. I have difficulty seeing it as a single upwave because the internal swings in the start. Could you please comment on that? Yeah, it's just, the way to think about this is that the Weiss wave, which is on this chart, this is the wave itself and the wave volume. So they're set to a mechanical number. On this chart, it's set for 3/4 of a point. This is the S&Ps, the ES, right? The E-mini. So it's set for 3/4 of a point on close. So that will change the Weiss wave. All right, so here we start to move up, and you've got a wave down. It only goes for 1 bar. Okay, so that means that the difference between this close and this close was at least 3/4 of a point. It could have been 1 or 2 points, but it was at least 3/4 of a point. But then it flips, and so on this close here, it means that it was greater than 3/4 of a point or more, greater than the last close. So it comes up, and then it comes down for a point, and then it continues to move on up. So when it does that, and we don't have any significant waves in here, when we don't have any significant down wave, like this is a significant pullback. We've got a number of price bars here, and we've got a good wave down. So when we don't have that, I just kind of, in my mind's eye, I kind of add all this together. I don't, make calculations, but I just say, okay, this is one wave up. Okay. And you just do that mentally. You can't do it. You could increase the size of the reversal on the wave. You could make it 1.5 points instead of 3/4 of a point. And that's okay. You can do it that way. But now you've got a larger reversal. So in a lot of instances, that's not going to be great. So you really, it's the same thing of like optimization. You really can't optimize this. You have to learn how to use it as a tool, and that includes knowing its shortcomings. And this is one of its shortcomings. And every tool has shortcomings, right? It's not to say anything disparaging about David and his Weiss wave. This is the best thing going, I think. But it's, everything has shortcomings. So you just need to know what those are, and you need to be able to make adjustments. First large green volume really shows changing character of down move. Yeah, exactly. This would not occur if it's still in a big move down. What would the sign of strength look like if it was an effort versus result instead of sign of strength we see here? You wouldn't see it move up as much, and you wouldn't see this kind of acceleration here. This is late buyers getting in and pushing the market up. So there's demand in here. You wouldn't see that. If it were effort versus result, it would kind of die out fairly quickly, and you just wouldn't see the large move up and the kind of price action that you see here. Okay, good questions. Keep them coming. Although you're going to I'll keep you here late, unfortunately. All right, so let's shift now off of the intraday, and here's the 2009 bottom in the S&Ps. Now this is a weekly chart, okay? And again, what do we see? We see that acceleration of the trend coming down. We certainly see the swelling of the volume coming in, okay? And, you can see here, this is A. We get oversold down here. This was terrible. This was early October of 2009, or 8 rather. And this was when the buck was broken. when they broke the buck. In other words, money market funds no longer had a NAV of $1. They could now go under that for the first time in the history of all of this. That was very scary time. It was also around the time that Bear Stearns, I think, or Lehman Brothers, one or the other, was let to go down. But we're not talking about the fundamentals. It was just a very scary time. And this was, remember I said earlier that all the blue chip stocks would be tossed overboard? Well, this is where it happens, right in here. Right in here. And if you go back and look at that historically, you'll see that that's exactly what happened. We also see that swelling of volume coming in. Look at the volume in here. We'll discount that, but look at this volume in here. I mean, just take the average. And take the average of everything from before, right? You basically double in a very short period of time the volume going on. And again, a lot of selling, but somebody's in there buying, keeping this market from going down, okay? And we see it, the only place we can see it, you can't see it in the price bar, you can see it a little bit in the wide spreads, surely, but the real place to see this is in the volume. And so this starts to stick out like a sore thumb when you begin to look for it. And then notice the shortening of the thrust. Right in here, you can clearly see it. I mean, we made this low, then we made boom, look at that, and then smaller and smaller. And this is shortening of the thrust. And as we said, the volume tends to diminish when the thrust shortens. And you can see down here at B that, you know, our volume is quite a bit less than we were at A as we come down. Okay. So again, clearly a mature trend. We go from whatever this was, 1450 down to 550 in the S&Ps. My gosh, what a drop, right? That's a mature trend. We see it accelerate. We see it oversold here. Okay, these are all the behavioral characteristics. We see the shortening of the thrust. We see the swelling of the volume. We see the diminishing of the volume. This is the first sign of strength in here. Okay, that's the first sign of strength. And then we get the higher low. As I say, they come in different flavors. They have a different look. Can I show some recent Forex reversals confirmed by the Weiss wave? Yeah, we'll get to Forex. Don't worry. Okay. All right. So that's the 2009 top. Let's take a look at the bottom, rather. Let's take a look at the 2007 top. What do you notice here? What do we see here? What do you see here? We see the mature trend, right? But it just dies off, right? What happened to the acceleration, right? What happened to the acceleration? Well, let's look more carefully at this. Let's look more carefully at this. We're still on the weekly chart, okay? And we definitely are in a mature trend. This trend went on forever, from probably the 1987 low, or even before that, 82. Probably a 20-year trend up, right? Well, let's start taking a look at this and start to see what we can start to see. Well, first of all, here's a way to measure shortening of the thrust. It's a simple graphic. All we do is just draw a straight line up, and then at the swing highs, and I have them labeled here, we just draw a little crosshatch in here. So we have a swing high at A, and then it comes down. We don't care about it coming down. Now it comes up to B, so we can put that same level in here at B. It comes down. Now it comes up to C, and notice that the thrust from here to here has gotten less from here to here, okay? So we're starting to see the thrust shorten. Then we make one more high up here at D, and we got minimal thrust. So real shortening of the thrust coming up, okay? So that's one thing to notice about this. We also notice that on this down move, we get quite a bit of volume coming in. And look at this down move here. And look at how big this move is compared to the previous moves, okay? And look at all that volume coming in. That's your sign of weakness. It comes early in this. We don't get an overbought market. We don't get a buying climax. What we get instead is shortening of the thrust with significant supply coming in. Okay? And then it's followed by an upthrust, a weekly upthrust. Here's your short opportunity. And other ones occur too. Here on a daily chart, there's a nice upthrust. On a daily chart, I'm sure there would be an upthrust in here. There are other opportunities for this to occur, for you to get short. But the principles are what is important here. Okay? We don't have everything going for us. We got the mature trend. We don't have the climactic action and the acceleration, but we certainly have shortening of the thrust. We have swelling of volume. We have big volume coming into the downside. And look at even deeper into this, and you start to understand why I would use the Weiss wave and just think in terms of waves here. This is, you can see that on the move up to A and then to B, we've got some pretty good moves up, right? C, it starts to get shorter, and D, it shortens up. So the lengths of the waves going up get shorter. But the key thing here, and that's really important, no question about that. But what really drives this home is this down wave right here. Look at how big it gets compared to the other down waves. We could even go back in time even more. Much, much larger on huge volume coming down. Huge volume coming down. Much larger than anything we saw before. Okay? And this set up the upthrust in here, where we come back up and notice that the volume diminishes on the shortening of the thrust up here. And that upthrusts, and as we're going to see also on bottoms, springs are in their own right signs of weakness and signs of strength respectively. So an upthrust is a sign of weakness. It doesn't have to be preceded by this high volume here and this big wave down like it is. That's just icing on the cake for us. Just on its own, an upthrust is a sign of weakness, and the reverse, the mirror image of an upthrust, is a spring, and that's a sign of strength. We'll see plenty of springs here as well. Okay, a bunch of questions here. What do you look for when you had a good rally and then in the overnight session it starts to move in a range? What's the things to look for then? Same stuff, right? It doesn't change. It doesn't change. It's the same things. To differentiate between shortening of the thrust that leads to an eventual sideways move as opposed to shortening of the thrust that leads to a down move, do we need to see the change in behavior? Yeah, we need to see the change of behavior either preceding it or after it. If that change of behavior doesn't come, and look at this big wave down, right, to the downside, and the volume is strong. Volume picks up on this. The volume goes down on the rally and up on the reaction. So there, that's confirming all of this in here. If it just went sideways, then we would have to think more in terms of an absorption kind of a scenario. We're not going to talk about that tonight because that's not really a top, but that is, you do have to pay attention to that in the case of an upthrust. So if you don't get satisfaction within a fairly short period of time, then most likely you're probably in an absorption where it's going to try to eat through whatever supply exists here, absorb it, if you will, and then rally on up from there. But in this case, there was no possibility, I don't think, of absorption unless the Federal Reserve was somehow going to step into that. And that was quite a bit of supply coming into the market. Okay. Yeah, you really meant by sideways move absorption. Good. The last green line thrust up does not correlate to your graph on the left. This last green line here is this up wave right here. And it ends up here, and that ends over here. So this up wave really doesn't have anything to, the distance between here and here really doesn't have anything to do with this graph. This graph is measuring the swing highs and the distance that is created between swing highs. Okay? It doesn't dip down underneath here and measure this. So it's a different kind of, it's different measure of the same phenomenon. Just a different way of looking at it so you can see. Okay. Doesn't current market have the look of absorption versus a top? We're going to look at the current market at the end here. Is absorption at the bottom, or is it just accumulation at the bottom? Just accumulation at the bottom. Absorption occurs at the top. Okay, let's look at another market. I said we'd come back to gold because this is another great one to study. And I encourage you to study this stuff and find your own tops in the markets that you trade and your own bottoms in the markets that you trade and see if they don't comport to this kind of thing. So we've got, here we are, this is the daily chart now. This is that point from A. It's the same chart. We have that nice move up. We've talked about the matureness of the trend. We talk about the acceleration. Now I want to talk about the sign of weakness that comes into the market. And we see the shortening of the thrust again, okay? We go to this point, we rally up, we reach here, we have a little reaction. Now we rally up to this point here. We have a big reaction, and now we rally up just a small amount, and we get over to here. Okay, that's the measure of the shortening of the thrust. And if we put waves on it, you would have, you know, your waves kind of looking like this, and a big wave down. Okay, that big wave down. It's just the other way of looking at this. But the key thing to note on this chart is the same sort of story that we saw in the top of 2007 in the S&Ps. And that is, we get this big wave down, and look at, we don't even need to see waves. Look at the volume coming in. This comes down, this all the way down here. This volume is this down bar right here. Okay? And then we get some strength come in on this day, and the market tries to rally up, but look at the volume diminish. We see the shortening of the thrust and the diminishing of the volume. There's your trade right there. And you get good confirmation of this on the very next bar. It goes sideways a little bit, but that ain't absorption. It just starts sliding down, and then bang, look at this, and volume comes into the downside. So very weak here. Very weak market at this point. And you can see that the patterns are similar, and they're similar because it's all about human behavior on a large group basis. And that's what we see. Okay, now here's the top in SPY or S&Ps in 2000. This was the time I was telling you before where the nurses were telling me that the Microsoft was putting their kids through college. No problem, right? Everybody's involved in the stock market. Well, here's the top in 2000. And again, we don't get way oversold. Overbought in the trend channel. We don't have a trend channel on here, but we start to go sideways. We have shortening of the thrust occur and all of that. But what I want to highlight for you is something called upthrust after distribution. Okay, as I said, it's not that common, but when we see it, boy, just notice it, because it could be the end of whatever market you're looking at in terms of the upside to it. So we see at A some very large volume coming in. You can see that buyers were eager, and we see almost a straight up move. Again, Wyckoff would call this hyperbolics. Markets generally don't move straight up like that, and especially at a mature trend, it's not where we would anticipate seeing such a big move up. And notice that when we do push up and we do have some shortening of the thrust in here. Look at the volume diminish here on the rally up to B. That's not bullish behavior, where we see huge volume coming in below the top, and then after the top is penetrated, volume dries up. That's not bullish behavior at all. Neither is we start slipping back down and we don't hold that last swing high over here. We slip down substantially. We close kind of off that's the close right there of this bar C. But boy, that's weakness. That's supply coming into the market, even though we do see a little bit of buying coming in the afternoon. That's a lot of supply coming in. So we start to see that swelling of volume. Market tries to rally up. It goes nowhere on no volume. There's just no fuel for this market anymore. And bam, it just gets slammed down. I hope you all can see that this is the biggest down wave or down move on this entire chart to that point. Okay, to that point. It's the biggest down move on the single down move. You know, compare them to all of these. It's the largest single down move on this entire chart. And look at how it just goes straight down. It just plummets. That's weakness. Okay? That's serious weakness coming into the market. So this is distribution. There was distribution going on in here. And we just go sideways for a long period of time, 3 months, from whatever, April to end of September. Now, notice this isn't distribution because we're not hugging those highs. We're not up near the highs. We've just had a serious sign of weakness. And that would be, you know, if we rallied up in here and we held along in here and held this low maybe in here, that would be absorption, and then we would look to move forward. But we don't have that at all. We come all the way down to here. We retrace this last move down. Okay, what happened to all the buying, all the volume in here? Where did that go? Well, that is another clue. This move down here to D is another clue to us that this was what Wyckoff would call, or did call, buying of a poor quality. It's the average traders, the what do you call it? Did he call them weak hands, if I'm not mistaken? The weak hands coming in and buying because they think that the market's now, it's just breaking out above this level and it's about to go to the moon again. But a lot of selling is going on in there too. And so we come to a point where we move into this protracted trading range and we get an upthrust over here. And that's an upthrust that occurs after we see distribution. And this is our weakness. It's distribution as well, but all in through here and probably back into here is all distribution. In other words, professional money selling into, large operators selling into the market and building an inventory, either getting rid of their long positions and or building an inventory of short sales for an anticipated large drop in the market. We had that in oil intraday today. Yeah, I didn't see the oil market today. I was working on this presentation, kind of finishing it up. So here's the same chart or same period, 2000, right, on the weekly, and you can see that it's more dramatic on the daily. But what I wanted to point out is here's the distribution line in here. This is the distribution. If we looked at this on a point and figure chart, we would start to make a projection down. And then that would be expanded over to here. And we would project even lower. And somewhere down in here we'd get a good count for it. We're not going to do point and figures, but just to see that. And E is the point of upthrust. C is the sign of weakness. B is that weak rally. And you can't really see the volume that occurs in here because on the weekly, because it's dwarfed by the bottom down here in 2003. But you can kind of see that there's a lot more volume in here, that swelling of the volume. Certainly you can see swelling of the volume on the bottom here, right? That's pretty obvious. Here's a current, that's enough Asta. Here's a current stock. It's Medifast, MED. Hang on a second. Let me get Asta out of here. Go see. That's Mommy. Go upstairs. Hurry up. Get going. Go. Good guard dog, but he gets nervous and doesn't want to go up. Okay. So this is Medifast, or MED. It's on the New York Stock Exchange. This is as of today, I think. This is a weekly chart, or as of a couple of days ago. You can see one of those accelerating moves up. Hard to read this on the weekly. We'd have to drill down into a daily chart to see whether we could make anything out of it, whether we could make any acceleration and overbought characteristics out of it. I assume we could, given these kind of large price bars in here. And it gets swamped by this bar, and then talk about swamp. Look at the volume. My gosh, on this, right? And we come up here and we upthrust it at B. And even on the, even here you can see that there's some volume coming in. And now we've gone all along for several years here, 2, 3, 4 years since the high, but we can't get out of this supply. Okay, we can't get out of this supply. This weakness down here is still affecting this market. And so we have the potential for an upthrust after distribution of a long period of time occurring. And if this is true, we need to make a projection here, but we're looking at this would be a first target, and potentially down here would be a second target, depending on what the count looked like off of this. But this is a potential, is something to watch, or you can trade it if you want to, but at least we can watch this and see how it unfolds. Guard dog sounds like he's a puppy. No, he's 4.5 years old, but he's a good pup. Okay, so that's a live chart. Let's take a look at the 2003 bottom in the S&Ps. Clearly a mature trend. We are we have you can't quite see the acceleration down here. We're going to look at the daily chart in a second. We'll see it then, but you can kind of get an idea that we're accelerating down. We are certainly oversold in the trend channel. We're not wildly oversold, but we are getting oversold. We see the swelling of volume in here. Once again, look at this in this area. Just take an average in here, and it dwarfs whatever existed before. We see also the strength coming in the price bars here. Okay, the strength coming in the price bars. We don't actually have a sign of strength in here yet. We do on the daily chart, we'll see that, but on the weekly we really don't. That doesn't come in until really into here on the weekly chart. And keep in mind that when we're looking at multiple time frames, the daily chart is going to turn and show more than is going to turn quicker than the weekly chart, and it's going to show more than the weekly chart, because we're able to drill down. And it's the same thing if we were working on an intraday time frame and looking at the hourly as our sort of trending time frame, or the one that we focus on most, and then we're looking at a 15-minute or a 5-minute or a smaller tick type chart. It's the smaller time frame that's going to turn first, and it's going to show us the details of the higher time frame. So we can see here that on the daily, the same area now, this is the same area as the weekly. I'll just go back quickly here. A, B, and C on the weekly. And that shows as A, B, and C on the daily here. A, B, and C on the daily. And we've got the acceleration in the trend. We've got the humongous volume coming in. This is climactic action here. We actually have a spring at B. And as we came down, the volume started to diminish down here. On the rally up, off of the spring, we get strong volume and we get strong price action, including gaps, because this is SPY. So we would get that. But nice price action up, showing that this is a sign of strength. So we have stopping move here. We've got a stopping move and spring here. We have a sign of strength here, right? And as we come back down, we're holding a higher low, and that's marked by a spring. This is very similar to the upthrust after distribution. This is like a spring after accumulation. Okay, maybe you call it a spark or something. A spring after, or a SPAC, I guess. It's not, there's no R in there. So spring after accumulation. Bob Evans was the one who talked about upthrust after distribution. He never talked about springs after accumulation. I don't know why. But you can see here there's a nice spring. And notice that it comes back into this area here, this buying area, where they were buying. That was heavy buying going on. It comes back down, dips into that area, and we spring that, and then we get, you can see the volume coming in, a sign of strength here off of the spring. And remember, springs by themselves are signs of strength, but we want to see the sign of strength occur after the spring as well. Otherwise, they may not be valid, okay? Especially if we're buying a spring in a downtrending action. What I'm showing you is how to override that. Springs are normally not a good buy or a purchase in a downtrend because they fail a lot. Just eyeballing this chart, we're making a lower high in here, and this is not a great spring, but there is a spring here. But notice we don't get, see how the action is here? We start to immediately roll over. Compare that to this action here or this action here. We get immediate gratification to our long position. That's one of the characteristics of a great spring. And I love springs. I'll buy them almost any time, as long as they're not in a beginning in a downtrend. Can I clarify the difference between stopping volume and climactic action? Not really. Stopping volume is I think it's a term used. Climactic action would be, the mature trend, the acceleration, and then the humongous volume that we get. So this would be climactic action. But it stops the market. So they both do the same thing. It's a sudden increase in volume in a down move. This is a stopping volume. A sudden increase in volume on a down move that shows buying coming into the market and stops the market. Here's a quick example of what we might call stopping volume. That's the volume there. We're in a down move. It stops the market. Market tests it a couple of times. We move up to some degree, but then start coming back down again. But that would be stopping volume. So the main difference is stopping volume is sort of like a small climax. Wyckoff called them climaxes. I don't know where stopping volume came from. I think Tom Williams, if I'm not mistaken. Seems like that entry on the last weekly chart was a potential spring. Yes, it was. It was. This is daily chart, though, right? The weekly also has that spring action here, okay? And we have a spring in this on B as well. So only trade springs in uptrends and after accumulation. That's what I would do, Roy. Difference between a spring and a springboard. Springboard is, we'll see a couple of examples of springboard. I'll show you what that means. Okay, see you, Scott. Scott's got to take off. All right, so we're at least an hour into this now already. Does everybody want a break? We're a little less than halfway through, so we probably ought to take a break, if not now, within 10 or 15 minutes. Yes or no? Would you like a break? Okay, I think the yeses have it. Some folks say no, but most are saying yes. Okay, let's take a short break. It's now, let me see, 6:18. So let's go to 6:25. Okay, and I'll put this on pause. Okay, we're back recording again from the break. So here's a bottom from the S&Ps, and this is from 1998. Now, this doesn't look like much of a down move, but this was actually 23% that occurred to the downside in like 2.5 months. It was pretty dramatic at the time. And you can see that at A, we begin the down move with large volume coming in. There's some weakness coming in right there as the market moves down. And certainly B shows supply as well. At C, we get the largest volume on the chart. And by this point, you would have to be thinking to yourself, I'm seeing swelling of volume coming in here. And clearly over the entire down move to E, you've clearly got that swelling of volume. And if you do the little trick of just eyeballing the average, it's usually about twice the average volume. And that is just an easy way to understand that this is a lot of activity coming into the market, and potentially the spot where a bottom may come in. Okay. So on C, we have a big widespread down bar, but the market closes off the lows, and we've got very high volume. So we know that there was some buying coming in. D, it looks like it's less volume, but it really isn't. That's quite a bit of volume to the upside. We don't come down at all. We basically open the next week and go up from there on strong volume. So that indicates, that in itself is a little bit of a change of behavior, but it indicates that there is buying coming into the market. Market rallies up and then comes back down to E, and we see volume is less than C, certainly. So selling is dried up quite a bit. And if we were watching this real time, when we were underneath C, I would almost guarantee that the volume would have been fairly low. And all that volume came in on the buy side as the market moved up. And this is a weekly spring here, another spring. Okay, so let's drill into this a little bit on the daily. It's the same period here, A and C. I didn't do that very well, did I? Sorry about that. This C and E is actually A and C here. This would be C and E. I'm a little bit better than that on following charts. But okay, so for now we come down. We see some acceleration. We certainly see that we're oversold on the daily, and we also see that swelling of volume coming in here. Notice that A is this volume here, and the very next volume, the very next bar is strong and goes up, and that is this volume. And I highlight that as B here, okay? And that's buying coming in. That's strong buying coming into the market. So for the first time in this down wave, we see some strength coming in. We rally up a little bit, break the downtrend channel. If we extended it, this downtrend channel is broken. That's a sign of strength. We come back down into here, and then we come back down to this same level and spring. So here's a great spot to buy. Notice too, I've highlighted these little dips down as AC. Okay, we dip down, volume picks up a little bit, it pushes the market up, we come back down, volume picks up, pushes the market up, we come back down, volume picks up a little bit, not as much as before, we don't really push up, instead we're coming down. So, but this whole area in here is accumulation. This is classic accumulation where we keep dipping down into the initial buy spot here and here and here and here, and then flush it out the bottom for any premature longs, get rid of them before the market starts to drive up. But this is classic accumulation in here. Keep dipping into the initial buy spot. We see good volume coming off the bottom, and we see very good volume coming in here at D. Okay, and so that gives us the sense that this is about to push on up and go higher. So that was the 1998 bottom. Again, mature trend, oversold, a little bit of acceleration, swelling of the volume. Buying strength in price bars come in. In this case, we see some accumulation. That's pretty obvious here. It's not always obvious. A lot of times it's not obvious at all. And then we get a spring, which is a sign of strength in its own right, but we want to see that sign of strength continue almost immediately, and that's exactly what we get here on D. Okay. Why do I call it AC? Just accumulation, just a thanks for coming, Natasha. Natasha says she has to go. Okay, so let's look at now the 2011 bottom that occurred when Moody's and Standard & Poor's suddenly got religion and said that and downgraded the U.S. credit, the U.S. bonds and government credit, right? They weren't doing it at all for the credit default swaps. They gave them AAA ratings, but they gave the U.S. long-term bonds and what have you a downgrade. So that shook the market out quite a bit. Look familiar to you? Does this look like the 1998? This looks similar to 1998? You bet it does. Okay, these, as I said before, these patterns are trader behavior. So I'll look at this both on the weekly and the daily. On A here on the weekly, we see strong volume coming down, so we know that this is negativity coming into the market. But look at what happens on B. You would never see this behavior if on B, on higher volume than A, and the market closes firm like this. You'd never see that kind of buying if this market were truly weak. Okay, we rally up a little bit. We don't have volume following through too much here. We come back down and then we spring on C, and the volume is substantially less than what we saw earlier, and we get that immediate sign of strength coming up. This tests in here and then continues to go on up. Okay, so let's take a look at the daily here. We don't really get a acceleration in the trend because this was just one big massive move down. So just based on not on the trend channel, but just the move itself, this is oversold in here. It's just way too much to not be oversold. We see the swelling of the volume. We see strong bars start to come in on strong volume in here. And again, we dip into, same as 1998, we dip down into that area of buying, right? And then have one more flush down and spring the market, perfect buy spot here, and the market takes off to the upside. And again, as we dip down and hit those accumulation areas, volume tends to pick up, and that stops the market. We talked about stopping volume. This is a mini little stopping volume. And then that pushes the market up higher. But the same exact stuff as we saw in 1998. I mean, you can't make this stuff up. It's trader behavior. All right, let's take a look at cable here. This is an intraday Forex chart, the pound versus the dollar. Okay, so we have a good down move, which is, I didn't put the numbers in very well, but that was a pretty good move for the pound. We see, and somebody asked, what do you do when you see the market go sideways overnight? Well, here's a good example of that. This market does trade pretty well 24 hours, so you can see it. As we come down, as we get lower down here, we can see that we're not getting, here's another way to measure shortening of the thrust. That's what this blue line in here signifies. We're not getting all the way down to the trend channel. We can draw another trend channel in here. I've got it dotted, right, and it shows. And if we were to draw that little graphic and do this, we would see that the lower we get, the less move down we get. Okay, that's why it looks kind of like a wedge. And we come down to A and we find a bottom here. And we go sideways. We come down to B. A little bit of volume picks up in here, but it doesn't push the market down. That should be your first clue that this market is not going to go any lower. We come down to C, less volume now on B, so clearly no supply. Somebody asked, where's the springboard? Here it is right here on this black arrow. We don't have a nice firm close up here, but we're just sitting right at, kind of right in the middle here. If we were to kind of think of this as a little bit of a trading range in here, we could draw like a little apex in here, a little triangle. There's the springboard right in there. And the market takes off, and we get a strong sign of strength in here as we go up. So again, kind of a mature trend. We don't get seriously overbought, but we do see the shortening of the thrust. We see the volume diminish on the shortening of the thrust. We see some of the price bars show strength in here. We come back. We don't go down any further. And then we get on the springboard and have a spring and then a test of the spring and get on the springboard right after the test and get a sign of strength from there. Okay. Here's crude oil. Boy, do these look similar or what? We saw it on the weekly, we're seeing it on the daily, and now we're seeing it on the, forget what was the cable there, 15-minute chart, and here's 5-minute crude oil. So here we do get oversold, we do accelerate in the trend, we do see shortening of the thrust, we see the volume swell. Here at B, looking at this, you would think that the market was going to go down, and that would have been a fair assumption. But it doesn't do that. It turns right around. Why? Because it's oversold. We wouldn't be able to know that. I mean, I'm not that good of a trader to be able to say, oh yeah, this is going to be fine. If we were watching this, and this is a 5-minute chart, we might try to buy it in here as it's going up. But I'll tell you what, it would be difficult to buy this. At least I think it would be. Nevertheless, we see pretty good volume. I know it's diminishing, but look at the size of the volume compared to the last rally we had in here, or in this move in here. We've got quite a bit of volume on this move up to D. Okay, so we have now a sign of strength coming into the market. And now we look for another opportunity, and we get that higher low in here in the terms of a spring, which occurs on this little bar right here, which is also a spring bar, a springboard bar. Springboards are often bars that are at the end of a sideways line here that go in, that are inside the previous bar or the previous bars. And then we get that nice confirmation that the spring is good. We get another spring over here, but it's getting late in the day. But it continues on. Okay. So we can see this stuff on all different time frames, but it's the mechanics of it and how the structure and the behavioral characteristics work. All right, let's go back to cable again, back to the British pound dollar cross rate, and take a look at this and see what we've got here. Now I'm going to show you how to do this on an intraday basis, multiple time frame basis. So we have here a 60-minute chart, okay? And we can see that on the 60-minute chart, cable is oversold. We came down here at A, pretty strong move down, and we see buying coming in at that level. We push back down. Sometimes this happens in the markets. We have some pretty good volume, but we really don't go much lower here. We rally up, not much volume comes in. We come down to C. Notice how the volume is diminishing as we come down to C. Notice also we have shortening of the thrust in here. As we come down, we're making less and less progress to the downside. Okay? So we have oversold condition, shortening of the thrust, diminishing volume, swelling of the volume where we want to see it. And then we'll take a look at this area from C to D to E. So we're at C now on the hourly chart, and maybe there's something here. We can take a look at the daily and see what we can see. Okay, so this area here corresponds to C on the hourly, and this area up in here corresponds to D, and then this is E. So I'll shift back to the hourly chart just one last time so you can see. Here we have C, D, and then the rally up to E. That's the area we're looking at because we know that we're oversold in here on the hourly chart and we're getting shortening of the thrust. So maybe a trade is there for us. Okay, so down here at C, what do we get? We get the market moves down, kind of holds in here. We see a little buying coming in, not much, but a little bit. And then what happens? We get a spring at 2. Volume is less, which is always a good sign on a spring. Not necessary, but always a good sign. We get what happens next, a sign of strength. There's our sign of strength. Good volume comes in on good price action. And then we come back down sideways here. Volume doesn't really do much. We have a little bit of weakness in here, but the market doesn't seem to respond to it. We rally up a little bit, we come back down, and we get another nice spring in here. And again, not much volume to the downside. And so we want to see more sign of strength come in on that spring, and bang, there it is. So there we are on the Forex markets, showing how this all works. So we've looked at Forex on a 5-minute basis all the way up to a weekly chart, and we see the same kinds of patterns here that we on all of the. It doesn't really matter what market or what chart we're looking at or what time frame we're looking at. We're measuring human behavior is really what we're measuring through the pictogram, if you will, of the charts. And this is what we see over and over and over again. But for these springs to be, understand this well, for these springs to be valid trades in here and in here, we have to have something going on the higher time frame. And we do. We're oversold. We have diminishing volume. We have shortening of the thrust. So on the higher time frame. So now we can go to the lower time frame and make something out of it. Even if you didn't take this spring down here at number 2, clearly we've got a prime opportunity at 5 here, which is D on the hourly. And let's just go back to the hourly here. We're right here. We're right here on the hourly. That's a nice move. And it even gets better. Okay? All right. Did you mean to say oversold rather than overbought in the cable chart? Probably. Yeah, if I said overbought, I'm sorry. I trip myself up a lot on those terms. Apologize for that. Did you use the term diverging volume? No, I don't. Diminishing. I say diminishing. I don't think in terms of divergences. I used to, use a fancy indicator that was supposed to pick good divergences when I first started trading, and I found that divergences were the absolute worst type of trade to make, and I quickly got rid of that. And so I don't like even to think in terms of divergences. So I like to see think in terms of diminish. Something is not going well. I did not see the day chart. Sorry, Roy, I don't know. Everybody else seems to. I can see what you see or what you should be seeing, and everything looks okay. So check your connections, relog in if you need to. On the 5-minute chart, would you go long at the green arrow to the right of 5? Oh, yeah. Just based on the spring and that there is strength in the background? Well, based on the whole thing, Lars, that's what I'm trying to say, is that the hourly is telling us that there is ending action to the down move, and the smaller time frame is showing us strength in the market and now setting up a beautiful spring. I wouldn't hesitate at all to take that. But it's not just because there's strength here and a spring, it's because the hourly chart, I'm right here in the hourly, I've come back into the, I probably didn't explain this as well as I could have. I've come back into the trend channel, the demand line here. And as I come down from this point to this point, I don't increase volume to the downside. So I know that the odds are that this move is now probably over, this down move. Okay? And I go to the smaller time frame chart and I find a choice opportunity, and that's what I trade. That's how you use multiple time frames. Okay. I asked because I would be scared of the ease of movement downwards on the 5-minute. Well, here you mean? But it stops. It stops. And yeah, there's ease of movement down, meaning that the spread increases and the price bar closes on its low. But I don't see volume pick up, and suddenly it just dries up in the next 15 minutes. Why did that happen? Why is it holding? This is a support level. This move up here is much stronger than this move down here. And I'm at support. We're back in here testing this. That's what they're doing. And you can even get more fancy than that. You can say, all right, I've got this support line right here. This was resistance and now it's support, and so the market should hold. I'd take that trade any day of the week. I love this look, this setup right here, because of the behavioral implications. Would I buy at the close of bar 5? Yeah, you buy on the close. I always buy pretty much on the close. I am trying multiple time frame when trading intraday. Which combination would you say is the best? 1 hour 5-minute or 30-minute 5-minute? I like the hourly and the 15-minute and the 3,000 tick. That's what I watch on the S&Ps. Strengthen the 60-minute, supporting the 5-minute. Yeah, you want to be looking at the higher time. You want to be trading the higher time frame. You don't want to be trading the 5-minute chart. You want to be trading the hourly chart, but the hourly is not the chart to be taking because you have larger stops, and the hour the bar takes an hour to complete. So you want to initiate trades off of the 5-minute. You want to coordinate all of that. One of these days I'll do a full-fledged webinar on multiple time frames, but that's a, you know, that's a really key thing to do. You really want to start doing that. You don't want to be looking at the 5-minute to figure out where your trades are. You want to be looking at the hourly to figure out your trades. When trading the right edge of the chart, if you have what you suspect looks like a good spring formation, what do you look for next to give confirmation for entry? Well, I take the entry, and then I look for this kind of move up. That's what I want. I take the entry, and it doesn't really matter where you take the entry, you know, anywhere in here, and I'm looking for this. That's my confirmation. Okay? That's my confirmation. And this is good confirmation too. We're moving away from, I go all the way up to this resistance in here, right? This little pocket of resistance, or this little level of resistance. I go from the spring all the way up there. That's pretty cool. Same thing here. Here's some resistance, right? I go from the spring all the way up here and you know, pretty easy shot up. I know that's strength. I expect this resistance to break. It holds here, but I expect it to break later on. And I get a picture perfect opportunity right here. I can't tell you how good that is. I should be trading the Forex markets. Okay, let's move on. Let's take a look at the S&P intraday tops now. We've taken a look at a couple of bottoms. Let's take a look at a couple of tops. Okay, so here we don't get that acceleration of the top up here, right, in this time frame. What we do get, though, is the shortening of the thrust. That's what this indicates. Right? We're moving from here to here, 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 and then suddenly it shortens up. Okay. I'm also seeing, here's where the Weiss wave just is superlative. I can see the wave down is bigger than any, I put these as little a's in here, right? These down waves. It's bigger than any of these. You can see that. But look at the volume. Now, I know it's not huge because you're being dwarfed by these guys over here, right? But compare this volume with all the other pullbacks since this uptrend began. And this is head and shoulders bigger than any of these other pullbacks. I selected this chart specifically for this because it's not, if you look at it first blush, you don't get it, okay? So we have a mature trend. We've gone from about 61 here to 76. That's 15 points. That's pretty good. That's pretty darn good in the S&Ps, especially for this time frame. And we get a sign of weakness. This is a sign of weakness right here, followed by an upthrust. And I'd actually take this first. I don't know why I put the arrow there. I wasn't thinking. I'd actually take the first bar that closes underneath here, and then it comes up and makes you a little uncomfortable, but the market falls down. You could also sell short this bar here too. Let me make sure you see that clearly. This one right here. Why? Because it comes up, tests the level of the upthrust and fails and goes down. That's just showing very weak, a lot of weakness. But you can see the weakness in the price bars here. It can't close above the high over here. We'll call it X. It can't close above X. But the key thing to notice is the wave volume is strong to the downside. We saw that in the other tops on the higher time frames, and here it is in the smaller time frame. And I love the Weiss wave on an intraday chart. Okay. Surely the Weiss wave is bigger because the pullback is longer. Yes, that's right. What causes the pullback to be longer? Selling. The pullbacks were short because the buyers were too eager to get in here, and they were pushing the market up, and there was no selling. Here, the buyers are spent, and the sellers are coming in. Okay. We also have, we talked about this before, some effort to go up, effort versus result. Okay. We have the biggest up wave here, wave volume, but we don't get above the last swing high. So for all that volume, there was selling in that volume. There was a lot of buying, but there was more selling, is the way to understand that. Okay, let's take another look at this. What sticks out at you here? What sticks out at you? What sticks out here on this chart? The first big down wave. Yeah, Edmund, how are you? Good to see you, man. Yep, this should stick out like a sore thumb, showing you the supply coming into the market. So we can look at this. We don't have overbought, accelerating trend. What we do have is shortening of the thrust. This is another way to see it. We would expect the market to come up to the top of the trend channel, right? But it doesn't do that. So therefore, the thrust up is shortening. It has to. It has to, okay? Then we get this big down wave, bigger than any of the other waves in here. Okay, you measure it like this. Bigger than any of the other waves, and on substantially large volume. It's the end of the day, which accelerates the volume, but everybody's getting out of this market. If this was bullish, we wouldn't see that. And then we have a weak rally up in the overnight market. Look at this. This is probably around 7:30 in the morning. Okay, the end of the London session, pre-market for the US. And look at the upthrust that occurs. Upthrust after distribution from yesterday. And the sell short is right on that bar there. Picture perfect. Picture perfect. So we don't have we've got a mature trend. We've gone a good 10, 12, 15 points here. In the S&Ps, that's a good move. We don't have acceleration. We don't have overbought, but we do have shortening of the thrust. We have a sign of weakness by the size of the down wave and certainly the volume. And then we have weak price bars, and we have an upthrust on a lower high here after a lower low. And then the market just tanks. Okay. What would I say about the little down volume after the big down volume? Just that it's not ready to go down at this point. So the selling had dried up in here. That's all. But it's, this stuff doesn't go away. This kind of thing doesn't go away. And certainly this doesn't take it out. Okay. It's not to say you couldn't buy this in here if you wanted to. Didn't get you much. It was like about a 6 or 7 point move in the overnight market. I mean, it's telling you that it's not going to go down. But what you're looking for after this, you're trying to stay a couple of steps ahead of the market. And what you're looking for after a sign of weakness is a reason to go short. And this is your reason right here. Okay? Is that drawing out the bulls? No, it's just, it's coming back up and testing up in here to see if there's any more demand. There was buying on this coming down because of the high volume, but there was more selling. And so they come up and they test it. The market's always testing to see if there's still demand left at previous levels. Okay, take another look at a bottom here in the S&Ps. Kind of not a strong market down in terms of a accelerating market to the downside, but we do get oversold here. And very similar to what we saw on the cable chart, we have no real sign of strength. This is sort of an unusual one. We're not in a big downtrend move here. We've got some volume coming in here at B. It's hard to tell whether this is buying going on or if there's still selling coming into the market. Probably some buying because of the size of the volume. But it's truthfully, it's unclear here. But we do come underneath, and one of two things is going to start to happen. Either we're going to see the trend start to accelerate to the downside, or we're going to say that we're oversold and the market's going to come back up. Okay? If it's going to accelerate to the downside, it would show me volume coming into the market, but it doesn't do that. We have fairly light volume as we come underneath. So that's one clue that the market is not producing anything down. And then the other clue is that we come back up above the downtrend channel, and we spring. Okay, so this bar right here would be an okay buy, and mainly because we have diminishing volume here. We don't have much else going on, but we do have diminishing volume. If that's too aggressive for many people, and it might actually be too aggressive for me, maybe not, but I can understand where people would feel that way. What happens next? Well, what are we looking for? We're looking for a sign of strength, right? And don't we get that? We come all the way back up to the top and we see good volume coming in, better than the downside volume that we've seen. Then the market comes back. We come back underneath this little shelf here and spring on good, solid price action and very low volume. And so there's a good spot to take a trade. This is the best spot on this chart to take the trade. This is aggressive but doable because of the light volume. Okay? And the fairly weak trend coming down, the weak downtrend. So you've got to piece some of that stuff together. And some of that comes with experience, you know. You may not see that right away, but I'm trying to give you little clues and hints in here to understand it. How do I draw your channel lines? Do you connect the higher lows and then draw a parallel line? Yes, I use parallels. So when we're drawing a downtrend channel, I draw from the supply line first. So I draw this line first and then connect the intervening low with a parallel line. And that's how you do it. Not rocket science. The shorts are drying up, and then price shows the story because the price structure is more important than volume, right? Yes, that's true. That's very true. Very true. Okay, let's take a look at a crude oil bottom. I normally do not see a lot of Forex charts with the Weiss wave. Is that because Forex has tick volume only? Yeah, intraday it's got tick volume, but that's fine. I've read more than one study about tick volume, and I've read them going back into the 1970s and 60s, 70s. In commodities, we didn't have actual volume for a long time. It was always tick volume, and it's correlated. I've seen stuff anywhere from like the high 80s into about 95% correlated with actual volume. And somebody did a study in the last year or two. They do Forex trading exclusively, and they do a lot of research in Forex markets. I forget their names now, but it was published in one of the trade journals, and it was well done. I read the how they did the research, and they took actual volume they have volume from some of the major banks, and they correlated that with tick volume, and they had like in the low 90s. So, you know, that's good. That any correlation that's above 75 is a really good correlation. 1-to-1 means it's equal. You're going to see variation. You're going to see variation between different data feeds on regular volume. So, Forex people get the idea that they don't have volume, but they really do, and it's in the form of tick volume, and it's perfectly good. Okay. it was as high as 90% with the cable. Yeah, it might have very well been as high as 90%. There's some sort of a zigzag function. I don't want to get into that at this point, because that's taking us off topic, and I can tell I'm going to be at least another half hour here. All right, so let's take a look at the bottom in crude. We are close to being oversold here. We're getting down towards the trend channel, the bottom of the trend channel. We certainly see the high volume. We've got shortening of the thrust coming down. Sometimes it's really useful. It's hard to see this, that we have shortening of the thrust here. But one clue is that it pulls off of the trend channel a little bit. Then we get that sign of strength. So look at that. That's a picture-perfect sign of strength. I mean, this is textbook. Solid volume coming in. We break the downtrend channel nicely. We get a big wave up. Everybody see that nice big wave up? Much bigger than the earlier waves up, right? Much bigger than the earlier waves up. It's like 3 times the size. That's a sign of strength. So now that that's in the background, we want to trade this. And so here's a nice low volume pullback, great bar to enter on. A nice strong bar to enter on. Here we get a spring. You can either enter it here or on the test of that spring. Either one is fine. So you have a couple of nice opportunities. So one of the things to remember is that when we get a bottom in place, or a top for that matter, that you don't have to get in right at the bottom. You know, this is hard to get in here. We don't have a good entry in here. All you got is shortening of the thrust, and we're near the bottom of the trend channel. We don't have a sign of strength yet. But here we do. And so what? So you missed this, but you got all of this if you held it. Okay? Okay, let's do some bar by bar now. And we'll take a look at also integrating some multiple time frames. Here we're going to work with General Motors, a well-known stock. Okay? This is kind of interesting. Monthly volume is not... I don't know, Wyckoff never looked at volume on the monthly chart. I don't really look at it either, but I put it in here because you can still read it. It's kind of interesting. We come down, we're closing off the bottom, so some buying came in, and very high volume has come in here. We make our way down a little bit lower on 2. We see volume diminish. Also notice, because this is a monthly chart, there are waves in here. You know, if you can see in between daily waves and weekly waves. And so what's actually happening in here is shortening of the thrust is occurring on the smaller time frame. We'll probably see that. I forget now what the chart looks like. But on 3, we get strong buying coming up. Not lots of volume, but certainly in price action. We come back down and test that at 4, very low volume. We come up to 5. We rally back up to the top of 3, and typically in one of these bottoms like this, we're not able to go much higher up. We're not doing a V spike reversals, but we're going to build some accumulation potentially. And so we come back down, and notice as we come back down on 6 and 7, volume's not really expanding. Certainly look at 7, it's kind of drying up here. And then at 8, we get a monthly spring here. Dips underneath the lows at 2 and 4, and then closes up. And look at the volume. There's no more supply here. Okay? So this is a monthly chart, a monthly bottom. That could be significant. So let's take a look at this on the weekly chart. And so this corresponds to why did I do this ABC instead of 1, 2, 3? I'm sorry about that. I didn't do the numbers, but this would correspond to the monthly chart. But again, you can see as we come down to this level, buying comes in on the weekly, right? We see that nice volume coming in. We come back down to B, and we see volume dry up down here. Still, we see buying, and we're holding in here pretty nicely. We get a good rally up, a good sign of strength. This goes up above, I guess this would be 3 and this would be 5 on the monthly chart to give you a sense. We come up, there was still a lot of buying, but it didn't continue, and we start coming down here. We have some weakness in this bar, and we get some volume coming in. But as we come down, two things to note. It's choppy. You know, compare it to this down move here. Here we're moving with ease of movement. Price bars are widespread, wide ranges in here. Here they're kind of overlapping. A lot of, you know, we go down, we go up, we go down, we go up, we go down, right? And there's not a lot of movement down. There's what we would say no ease of movement to the downside. We also notice that volume is diminishing. And we come down here to D, and we have all this volume in here. There's just nothing. There's no volume. And actually we dip underneath on this week and look at how low the volume is. A holiday, or not a holiday, but summertime. And it's just begging to be bought. Just begging to be bought. Okay, so you can confirm what you think you see on the monthly. And then we come down here to the daily chart, and we see no oversold condition in the trend channel, because remember on the weekly it was sort of a lackluster move down. But on the daily we see that there's shortening of the thrust in here. And this blue line is the monthly support line. And look at what happens on the daily. So there's your buy right there. And if you didn't like that, you wanted a sign of strength, here's our sign of strength. But remember, springs are signs of strengths in their own right. Up thrusts are signs of weakness in their own right. But we want to see it followed by a sign of strength, and we do. We see good volume coming in, move up. So you got another opportunity to make a purchase in here somewhere. Okay? As we pull back after the sign of a strong sign of strength, and we see volume diminish again. Okay, so that's coordinating on 3 time periods. Let's take a look at cocoa. Again, multiple time frames, and we'll look at the monthly chart first here on cocoa, and we can see A, B, and C. We see the shortening of the thrust. That should be obvious. As we go up to A, we're going to look at A first, then we're going to look at C. So as we go up to A, we see that we're overbought in the trend channel and we've accelerated up. Okay, and we also have a little shortening of the thrust in its own right, because we go from this level to this level to this level. And it gets smaller as we go up, and we also see that diminishing volume. Okay, same stuff. So here's the same area, A, on the monthly chart, but now we're going to look at A on the weekly chart. Okay, so what do we see? Rally goes up. What's one? That big sign of weakness, the biggest down bar on this chart. Okay, so that should immediately flag anybody trading this market. We want to know, we want to now look for an opportunity to go short. So we start to rally up here, and at 2 we get volume coming in underneath here, underneath the resistance. We'll call that X for the moment. And then as we push up above X, what happens to volume? It diminishes. And remember, we're shortening the thrust here. We see shortening of the thrust. We don't know it until 5 occurs. We don't know for sure. But on 5, we get a gap down. Oh my goodness, look at this. Weakness. Talk about weakness. Or 4, rather. And volume picks up, of course, and continues on 5. We come back up at 6 and test. We don't see volume pick up like we did here at 2 coming in this area. Last time we were in this area to the upside, we had this big volume. Now we come up to the same area, same level, and we don't have that kind of volume. So we see the market start to come down, and then we come up here and look at this, no demand after an upthrust. So we have the upthrust and then a no demand test of the upthrust. There's your short. There's your picture perfect short opportunity right there. Okay, for a nice down move in cocoa. But let's go to the daily chart now on this. We can see that it's the same area. We can see that weakness coming in at 1. We can see that big volume building up. We see the volume press up here even more clearly, but then once we get above X, again we'll call it, volume just dries right up. Okay. We see on the last 2 bars here, A and the bar before A, a pickup in volume and no ability to move up. So now we come down on that gap and we see the big sign of, this is a big sign of weakness here in its own right. Okay. And now we come back up here on 5. We have an opportunity to short here. But as I said, the best short is really in here on 7. And so we would drop down to the daily chart and make our short in here. Okay. Again, coordinating these. Okay, back to the monthly chart. Let's take a look at C here, the area of C. Okay, just this is it's going to be this area here. It's upthrusting B. And we're going to take a look at the upthrust of B on the weekly chart. Interestingly, we start up pretty strong here on 1, but look at what happens. We get more volume coming in on 2, and look at the closes, they're poor. So this is trying to break through the supply that we saw over here, okay? And it's saying that there's still more supply in the market, but they're closing poor. But we're not immediately rejecting, because on 3 we rally back up. So there has to be some, so now we know that we're not going to just die off here. We're going to go a little bit higher. But look at what happens on 4 and the bar after 4. Just the volume is diminished here as we approach resistance. B is resistance, right? This is where supply came in and stopped the market before. So if we don't have good volume coming in on here, we're not going to be able to push through. There's no way. And then look at C. This is the upthrust bar right here. We get a pickup in volume and we come down, we go back up, and we close poorly. We close underneath B. Okay. And we get immediate gratification on D. We get in the bar after D, we pick up volume all the way down. And then we get a couple of no demand tests up in here, but particularly at G, you have a very nice opportunity to enter on the weekly chart, okay, if you were trading off of the weekly in this market. Let's drop down to the daily chart to see what's happening here. Even more clarity comes into play. We get a good rally up to 1, that looks fine. An okay pullback here, we actually get a spring at 2, that looks good. Okay, that looks good too. And now as we move up to 3, we see volume is not keeping up with the prior rally. We were expanding volume here, and now we're losing volume here. And we get that really wide spread bar in here that we saw on the weekly. There's supply coming in, and then we try to push up here at A, but it's very weak, and we see weak price bars, and look at that beautiful entry right there where the arrow is. And then we start coming down. And there are other opportunities at some of those other points too for going short. So you can see that the we have a lot of different tools that we can use. We've got the Weiss wave, we've got tick charts, we've got individual price bars, we've got multiple time frames, all of which are valid, all of which are very useful. And what we want to always do is keep those principles in the backs of our minds. And what we first started with, the first 2 slides of this presentation, as I said, were the key ideas here of the mature trend, the becoming overbought or oversold, the shortening of the thrust, the diminishing of the volume as the thrust shortens, the weakness in the price bar is the sign of weakness, and then some kind of ending action in terms of spring up thrust or lower high or lower low, and the swelling of the volume coming in at that point. Okay? In summary, could you list the most important signs of strength weakness that you always look for at bottoms and tops? Yeah, the most important thing is going to be a sign of strength or a sign of weakness. And we see that in terms of wave action, where the opposite wave gets larger and the opposite to the trend, and we see the volume come in on that. Or a spring after we see overbought or oversold. I mean, those are the two. Or up thrust when it's overbought. But it's not that it's not that we can weight these or rate them and say, well, overbought gets a 10 and weakness in the price bars gets a 3. It's not like that at all. You want to piece together a few things. You don't want to just see one thing. So in other words, if you see shortening of the thrust and we're down pretty close to the bottom of the trend channel, and then we see some positive price action and then a spring, that's a good story, so to speak. You want to try to make a story of the principles of of the Wyckoff principles on what's happening in the market at the moment. All right, I want to go through just a couple of the last 3 intermediate bottoms in the S&Ps, because we've had such a strong uptrend. And this is as of, I don't know, it must be today, I think. This is a weekly chart of the S&Ps, a continuation chart. We're just going to look at these last 3 pullbacks in the S&Ps. And it's very similar to what we've been talking about. So here's pullback number 1. This occurred in July, about a year ago, I guess. Okay, we've been on quite a long run here. So we come down in this market, and notice at 1 and 2, we see good price bar action. There's buying coming in here. This is the daily now. We're going to do, looking at multiple time frames. We come down on 3, and it looks like we're going to go down further. You'd have to think that with all that volume, no question about it. But at 4, we see large volume, and we don't go anywhere. We close the same as the day before. And then the next day at 5, pretty similar volume, still pretty high volume. And now we've got this idea that we've got some swelling of volume here, and yet we're oversold in the trend channel. Okay? And then suddenly we spring here at 6. If you're an aggressive player, you can buy that spring. Because we've got enough of the background. We've got oversold conditions, we've got swelling of volume, we've got positive price action, and we have a spring, which is a sign of weakness, a sign of strength in itself. But if you're not comfortable buying that, we come back over here to 8 and look at the low volume. That nice test a few days later of the spring comes back down roughly to the same level. And remember, we said there was buying here and buying here. And look at the buying that's going on here. All those closes are in the same spot just about. That's our buy zone in here. And we come down, we have this low volume test. And there's a great opportunity to go long. And we get a strong sign of strength after that. Okay? So people get excited about some of these pullbacks in the S&Ps, and that's one of the reasons why I wanted to do this last little part. These are not big bottoms, but they may be more in terms of the kinds of things that you all are seeing all the time, rather than maybe these monthly charts and stuff. I don't really know, but I thought I would do a little bit of work on this before we left this seminar. And so here's B. This happened right around the 1st of the year, February or so. And look at what happens. We get oversold in the trend channel. We get the volume picking up in here, right? On bar 4 and the bar before 4, we can't make any further progress down. Then we spring this level from back here, from back in December on 1 and 2, where there was strong buying coming in. So why wouldn't we expect that buying to come back in and occur here too as well? And we get an immediate response off of that spring. It's just picture perfect. Just picture perfect. Okay. And let's take a look now at C here, the last pullback that we had of any note here. And again, on the weekly anyway, and again, it's the same story. We get a down move here. We see the volume pick up. Not much progress after getting oversold here, or close to oversold in the trend channel, and then we spring that level at 1, and that's a great trade right there to spring that, because we didn't even go down and spend much time down there. And we rally up, we break the downtrend channel here, the little one, and then 6 and 7, I just highlighted these because it's showing that there is some supply here. Somebody was asking about what about absorption? Well, there was some supply in here. We can see that at 2 and at 3. There was strong move down here, strong volume down. There was some kind of news or something, I guess, in here. And so there's still, that doesn't go away, as I say before. So also there was an upthrust here, that the red line here for that we'll call that X here. That resistance line was an upthrust. So there's a little bit of weakness in here, and the market is going sideways to absorb that, and it does that for a couple of weeks. But these bars here indicate there's still a lot of strength in this market, and that's eventually how it all resolved itself. We get a little shakeout here, which would make anybody pause with that kind of volume, but then it immediately is followed by strength, and the market goes up. Let's see some comment here. 2 key words to remember from today's class: structure and behavior. Yep, absolutely, Rama, absolutely. Okay, so here's the current market. Here's the S&Ps. I use SPY for that, for the S&Ps, and here's the 2007 top. Put that in. And the 09 bottom. And then we had this little top, which wasn't really all that much, but the 2011 hiccup here with the credit default. This was the flash crash here. So what do you think? Are we in? What do you think about this? Are we seeing any major sign of weakness in here at this point in this market? After going up for 1, 2, 3, 4, 5, going into our 6th year in a row? No, right? Nada. That's right. Nothing. So even if you're a day trader, it helps to look at the higher time frame. Okay? It helps to look at the higher time frame. But let's put some trend channels on here, because you do need to be aware of this. We are seeing some acceleration of the trend. I don't see any sign of weakness in here yet. I don't see any shortening of the thrust or anything else. And we're not overbought per se up in here. We probably still have one more push up to go. But the main money that could have been made out of this uptrend is probably behind us. Not to say that more can't be made to the upside, but we're getting probably close to coming in, at some point in the next few months into a top. So just be aware of that. Be cautious of that, okay? Because we are accelerating. We have one thing coming in here to play, but we don't have enough to certainly not enough to say, okay, let's go short now. All right, so let's just take a look about what we talked about, the structural and behavioral characteristics of tops and bottoms. And as Rama says, this is probably the most important 2 words to remember from this. We've looked at a lot of the major tops and bottoms in recent days. I didn't go all the way back to like 87 and all of that, but there's not a lot of difference. You get the idea. Okay, you get the idea. Springs and upthrusts. If you don't understand this by now, I probably can't help you too much, but these are really crucial. We see these all the time. So what you want to do is integrate the idea of a spring or an upthrust on a smaller time frame with a larger time frame chart and the background or the structure and the of the market. Okay, even on the same time frame, you want to do that. We talked about upthrust after distribution. We saw a few examples of that. It's not as common as just straight ordinary upthrusts, but upthrusts after distribution kind of have their own melody to them, and they're very important to be aware of. Okay. We talked about some entry ideas. Not a lot, but drop down to the smaller time. The basic idea is to drop down to the smaller time frame and look for some strength to come in. We talked about the use of the Weiss wave. I didn't show you anything on the Weiss wave on the higher time frames, where it is very, very good as well. But where it really excels is the intraday charts, especially when you use them in combination with tick charts. They can certainly be used with a smaller time frame, like a 5-minute chart as well. We looked at multiple time frames. I think this is really important to do. Otherwise, you're just trading random stuff. It's noise more so. You're trading off of one time frame is really not a good idea. Really not recommended. You want to look at multiple time frames as much as you can. We looked at bar by bar reading. That's critical too. Not just the principles that come into play, but you got to be able to see it unfold, and you have to be able to know when the right time is to pounce on your market, so to speak. And then we looked a little bit at current market conditions, including the recent bottoms that occurred in the market. That's the end of this. I just want to say two things to you on this webinar, and that is that my book on trading psychology will be out. They say December 3rd. We'll see. But it's being published by Wiley in the Wiley Trading Series, so I'm pretty honored to be in that. And it's all about cutting-edge psychology. For those of you who don't know, I am a psychologist. I have a doctorate in psychology. I started out as a clinical psychologist and also worked with a fellow who is a sports psychologist and learned that for performance and have equated it to trading. And so I keep up pretty well on all of the current stuff in psychology, all the current research. So there's a book, this book will be out on trading psychology. And there's not too many of them out there, so hopefully this will be helpful to people. The other thing that I want to say is that we haven't been doing much with the website, and there's two reasons for that. One is that I've been working on the book. It took me 2 years to write. It was a serious undertaking, and I couldn't do a whole lot of other things. And so something had to give, and one of those things that gave was the website. And the other thing is that we are now just are about to hire 2 people, a webmaster and a designer, and spend a fair chunk of change on revamping this website. So you're going to see a new look, much better functionality than what's on there now. And once we get it going, which should be early this fall, we'll be doing a lot more posting on the site. I'll do more trading psychology as well, and we'll be doing probably 1 or 2 free webinars a month on top of it all. One on trading, one on trading psychology, or one on Wyckoff and one on trading psychology. So you'll see us be much more active with a brand new shiny website, which we're really excited about. We think it's going to be a really nice product when we get it done. So the website is still the same. It's tradingpsychologyedge.com. I'd like to be able to Roy says I'd like to be able to join Deep Practice. Yeah, we do this stuff in Deep Practice every week, and so that's a good thing, but it's late for him. So we record everything, and you have the last 4 sessions always available to you, so you can watch it. They run an hour and a half each week on Thursday night. So do I use sports psychology as a perspective a lot? Yes, I do, in the book. If I buy the book, will I sign it? Yes, we will. We're going to set up something for that. On the last chart of the S&Ps with 2 red channels, it looks like the price is not reaching upper trend line of more recent channel. Suggestion of incipient weakness. Let's go back to that. You must mean the blue line here. It's not reaching. Yeah, it would be. It would indicate it's not making it all the way up to this trend channel. It's kind of 601 because you are at the top of the other trend channel and you're pushing up through it. So there's still a lot of strength here. It's too early yet to be thinking about this as a lot of weakness coming in. All right. Let's see. Any other questions before we close it down? I appreciate everybody coming in and partaking in this webinar. I hope you got something out of it. I think Wyckoff is a brilliant piece of work. You know, his body of work, which is fairly small, is absolutely genius. And people like Tom Williams and David Weiss and a few others who've written about Wyckoff have also made some major contributions. And I hope that you got something out of this. I hope that it will be of help to you. All right, everybody. I don't see any other questions, so thank you very much. I appreciate everybody coming in. And good trading, everybody. Trade mindfully and look for those tops and bottoms. All right, take care now. Bye-bye.